Bond instruments are definitely not talked about enough in the media circuit. While many people propagate this whole idea of bond and stock mix, most people do not understand much about bonds beyond things like, oh, it's kind of like lending money law to a company or government, then they pay you interest. The reality is, fixed income, aka bonds, are very dynamic instruments with multiple profiting strategies. So, in our pursuit to keep improving ourselves, we had to dig into this giant world of bonds. Did you know that there's actually more money in the bond market than the stock markets? Welcome to another Chills with TFC session. In this series, we will bring on interesting, relevant people to help us learn better from various perspectives. Life is not always about learning from people that you already agree with. Perspectives shape a rounder thinker. So in our pursuit of the life we love or managing our finances well, our guest today is the General Manager of FSMOne, Jean Paul Wong. Yes, he speaks French, grew up in the Maldives, reader, pretty cool guy, and we spent a great time talking about bonds. Will it ever outperform equities? We talked about Asian high-yield bonds and their potential, and how to evaluate bond funds, because if you think about it, it is a basket of different bonds with varying maturity time and even varying risk factors. There's a lot to understand in this giant bond market. For reference sake, this episode was recorded on the 8th of April and released early to our community members. Thanks for loving what we do and empowering us financially to do more for you. Let's roll! There are many ways to invest,
Yes.
right? What are some ways that you feel are the most comfortable for retail investors to explore? How do they start?
I think for a lot of investors, we tend to be more familiar with stocks because maybe it's the company names that resonate with us, because maybe we kind of know, the bank or the property company and so on. So it's something very relevant to our life. So I think that's probably the normal way for most investors to get started. But I think for a lot of investors, if we're looking to kickstart our investment journey, actually a diversified form of many stocks or many bonds could be actually a good way to start, simply because it doesn't require us to know so much, which can be quite intense, into just one company.
It's very intense, right?
Yeah, so I think when I started off, I kind of wanted to, of course, dabble in stocks, and I think there's nothing wrong with that. It's just that I think one thing that I missed out when I started off, looking back in hindsight, is actually just to set the goals, to be very clear on the goals on why I'm investing. Because I think when I have the goals, then it gives me a very clear plan or strategy on how to do my investments. Yeah, and the reason why that's important, because there are so many things that happen in the stock markets, in the investment world, that can distract us. Yeah, and if I have that clarity of thought, let's say when I was much younger, then I think I would have given myself more time to be invested in the markets, and I think that would have been a good thing for my portfolio. But of course, it's never too late in a way, because I think along the way, those are lessons that I take with myself. Hopefully, I can share it, and hopefully, it's relevant to investors as well. Yeah, so I think one point that I wanted to share also was I think the emotions part when it comes to investing, I think is something that it's too prevalent in a way, in terms of how it makes us decide on what to buy and sell and when to do it, which shouldn't really be the case. Because when that happens, then I think we could be making an emotional decision that maybe doesn't fit with that plan and that goal at the beginning that we told ourselves we wanted to achieve. Yeah.
Yeah. And you talk about like distraction, right? What is a distraction versus an information in that sense?
I think distraction, it could happen in the form of all the news that we're surrounded with on a daily basis.
That's a lot.
That's a lot, yes. So you hear all the experts coming out saying, hey, interest rates may rise, inflation risk is on the rise, tech is expensive, you should do this, do that. And it can get very confusing, because different voices say different things. Different experts seem to be, contradicting themselves. When I look at it and I try to sieve out all this noise, whether it's from the investment websites or news portals, or even our mainstream media when it comes to investments, when I clear away all that noise, actually it's back to, so why am I investing? Is it to ensure that my emergency funds can do better than what I get from my bank savings account? And secondly, am I investing because I want to retire early with a certain income stream on a regular basis? Thirdly, because I have kids who are quite young, Am I trying to ensure they have some amount of money that would be of some use to them when they grow older? I mean, in the past, I used to be a bit more traditional. I would think, okay, they probably should have this money for their tertiary education. I think that should still probably be the base plan, but I think along the way in recent times, especially with the pandemic, I mean, it opens up, I think, my mind as well as to maybe what they could do with that money. Who knows? Maybe there's an entrepreneur in one of my kids, and if he or she wants to use that money, to
Let's
start a
go for it,
business,
right?
yeah, like how maybe you're doing yourself. So maybe why not? Yeah, yeah.
Nice. So
Yeah.
in that sense, you are also on the lines of like stay vested, understand your goals, and stay invested rather than time the market kind of strategy. Am I sensing that?
I think part of that is definitely correct because a lot of my goals tend to be quite long term in nature. So I'm referring to, let's say, 10 years, 15 years, or even 20 years from now. And then with that kind of time frame, of course, it's easy for me to say, let's stay invested. Let's not be too distracted by, market declines here and there. But I also know that there comes a time when we look at our portfolio, we should make some changes, a bit of spring cleaning, maybe at the end of the year or at the start of the year when it's Chinese New Year. Spring cleaning is a good time. So maybe it's good to just see whether like the tech sector, like last year, a lot of the disruptive innovation investments that I have in my portfolio, they ran up really fast last year. So is it time to trim some of that? So actually, while we stay invested, and I believe in the merits, if you have a long time horizon, it also doesn't mean we shouldn't, make tweaks to the portfolio in the shorter term.
Yeah.
It doesn't mean we shouldn't do a spring cleaning exercise once a year or we rebalance. So one of the things, for example, that I did earlier this year was to add to sectors that I thought were looking a little bit cheaper. So for example, the financial sector. So that's something that I shared with investors as well. And for tech, I'm still kind of exposed there. I took a bit of profits for one of my tech investments, but I see it as a very long-term play, especially for like disruptive innovation. So I still have some exposure, but of course it's extremely volatile this year because of what has happened last year, right? Because I mean, I was sharing with investors, no market or no sector just goes up indefinitely in a one straight line. So I think a bit of a correction is good, and maybe that's the time when either we add a little bit or we add to other sectors that are more attractively valued, whether
Yeah.
it's financials or so on.
Yeah, yeah. And you see, right, even in our short little discussion, it's about equity, equity, equity.
Yes,
Right?
yes.
So the general idea always seems like, equity is the main guy, like Batman, right? And then you have all these like fixed income or like bond funds as like your sidekick, right? So then,
Yep.
so like, is there any way, any possibility that fixed income can actually outperform, or like bond funds can outperform equities in the longer term?
Yeah. I think there's a bit of that impression for bonds. Like you said, like, it's a bit of a sidekick. Like it's
Yeah.
Robin, lah.
Yeah, I always
But,
feel like Robin,
not as high profile as the main character, right?
Yeah, yeah.
I think in some ways it's because when you take a very long time horizon, then I think equities tend to provide maybe better annualized returns than, let's say, bonds. But having said that, your question is about whether bonds can outperform equities, and the answer is yes. And it really depends on the time periods we're talking about. Firstly, secondly, also it depends on what kind of bonds we're talking about, because when we talk about bonds, it's not just one type of bond. So it's a bit like equities. When we talk about equities, maybe we're talking about global equities, like the MSCI World Index. But within equities, there's a lot of different kinds of equities as well. So for fixed income as well, it's very similar. I mean, very broadly, you have your sovereign bonds as opposed to, let's say, your corporate bonds. So these are your government bonds versus your company bonds. That's one
So
difference.
sovereign bonds are government bonds.
Government
right?
bonds, yes. The second kind of difference you may find it's you have your investment grade bonds and your non-investment grade bonds that in the market we call junk bonds, which may seem quite harsh, like junk bonds, but it's because they are seen as higher risk, and because of the higher risk, actually at different periods of time they can also offer quite interesting kind of yields or coupons to us as investors. But if I go back to your question, so if we look back at history, right? I think like during the GFC period, I think that's a classic example when
Great
when
financial crisis, right?
correct, that's right.
GFC.
So in 2008, right? Then you'll find that during that year, equities were bashed across the board. And and bonds were also bashed to some extent, but there was one category of bonds that did okay, and therefore, in a way, if you zoom in on 2008, there was one category of bonds that could outperform equities during that time period, and that's really your developed market bonds, more of your U.S. Treasury bonds. And why did that happen in 2008 is simply because when there are extreme market conditions, people are usually trying to escape from the things that are free falling, which is your stocks and your equities, right? And they want to go to something that's safe, so what we call the safe havens, and I think in this case it's really the government bonds, and they did well in '08, therefore. And that brings me to the next point, which is, bonds, therefore, are very different. There are different bond segments. So in 2008, if I use that example again, your non-investment grade or your junk bonds did very badly too. Yeah. So I think when it comes to us as investors, therefore, how should we look at bonds? Because there are periods where it can outperform equities. And that kind of gives us a clue already that when we build our portfolio, we would ideally want maybe two types of asset classes or more that are not totally correlated with each other. So hopefully, in certain market conditions, the equities may not do so well, but the bonds can do better, and vice versa. And I think that also therefore means that bonds always merit a place, lah. May not outshine Batman, but I think Robin deserves a place in our portfolio. Using your analogy. Yeah.
Yeah, definitely, right? Everybody has their own fans, right?
Yes,
Yeah,
indeed.
yeah.
Yeah.
But then, in that sense, could you just kind of help me elaborate a little bit about safe havens, right? Because people use this word pretty loosely also. Like, what is considered a safe haven? Is it a currency? Is it a government bond? Or how are we looking at? How do we define something when we call it safe haven?
Yeah, I think safe havens traditionally are seen as bonds that could be issued by, let's say, governments. But it's not also there all kind of governments, because there are some government bonds that have defaulted
You mean like
on giving out.
Argentina, right?
Yes, the likes of Argentina, you have Russia as well, and there's probably a few more. So usually one way to define safe havens is to look at let's say the kind of credit rating that the credit agencies attribute to the different sovereign bonds. So you would like to have bonds that are essentially investment grade for sure, if you want to go for the safety aspects. And depending on the kind of bonds, right, some of them could be AAA rated, or even your one single A rated. They could be seen as fairly safe, as opposed to those bonds that are rated worse, or even rated as junk bonds. Yeah, yeah.
But then, in that pursuit of safety, it sounds like the bigger countries, the bigger currencies are where the safety is. But then how then do we factor foreign exchange rate into that picture?
Yes. When we talk about, let's say, the bond market, then the U.S. market features very prominently. First, as a very large market, but also secondly because it's the U.S. So we're talking about the U.S. dollar as well, and I think a lot of the bonds, even in Asia, when you look at the corporate bonds or some of the sovereign bonds in Asia, they also are denominated in US dollars as well. So it's a currency that it's a very prevalent across bond markets across the world, not just in the US. And when you look at that, then of course, from a Singapore investor's perspective, if we're trying to preserve and maintain our returns in Sing dollar terms, then we have to be mindful that a Sing dollar depreciation or a decline in the Sing dollar versus, let's say, the US dollar, could actually be detrimental for us, depending on what we invest into. So yes, the currency part matters in that sense. And I think one way to circumvent or go around this problem is to go for a Sing dollar hedge kind of a currency class for some of the fixed income funds. But usually this kind of structure only exists, let's say, for bond funds, which are essentially bond unit trusts. If you go into bond ETF space, you don't really find like a bond ETF that has a currency hedge clause, for example. So it's not too common in that sense. So therefore, if currency is a factor that matters a lot to us as an investor, then I think maybe a bond unit trust could be more attractive as an option, especially those that are, let's say, Sing dollar currency hedged. Yeah.
Okay, that's cool. That's cool. And when we talk about like packaged together, many people are packaging all sorts of stuff, right? So in the bond fund space, how are things done, in terms of like packaging investment grade versus junk bonds, and then how do they come together into bond funds, right? Just kind of help us. I know that like all these bonds are 讲不完, okay, we cannot finish everything today, but
Yeah.
help us envision a process. How is this done?
Yeah, I think you mentioned the investment grade. So I think if you use rating agencies metrics, for example, like S&P, so you're talking about your triple B minus all the way up to triple A. So these are considered your investment grade, and there could be a bond fund that maybe specializes in just buying bonds that are, let's say, investment grade. And also the second thing they could do is they could say, okay, I'm just going to buy Asian investment grade bonds. So I think it's important to therefore look at the fund's objective, because that will tell us, okay, this fund is going to be giving a certain kind of a return because it's Asian investment grade, as opposed to, let's say, an Asian non-investment grade or Asian high yield or Asian junk bond fund, right? Then that one by right, I would then expect the kind of average yield to maturity to be higher versus the investment grade bond fund.
How much? Give us some context.
I think you could be looking at a difference of 200, 250, 300 basis points, depending on the kind of actively managed bond funds. Yeah. So in the investment grade space, you could be talking about, let's say, a 4% average yield to maturity. And maybe if it's a high yield Asian space, you could be talking about a 6.5% kind of average yield to maturity. So that gives us a certain idea as to maybe how much yield I can expect from these different bond segments. Yeah. And when it comes to how to package these products, I guess for the ETF issuers or for the fund managers who are essentially the active ones, then they'll be looking at the investment mandate, which is the investment objective I referred to. For ETF managers, in a way, the task is maybe you can say a bit simpler. They'll be looking at index, right, and try to replicate the performance of that index. Whereas active fund managers would be also having an index, but by right, we pay them a bit more management fees because they are supposed to deliver better returns than what the benchmark can. Because if they cannot, then of course it makes sense to just go for the index bond ETF. Yeah. But I think for bond ETFs, the other interesting thing to note, as opposed to, let's say, an equity ETF, is that an equity ETF, in terms of what the ETF issuer does, he could be buying essentially the whole index of stocks and trying to replicate that index very closely. So the tracking error, which is the difference between the ETF and the index that it tracks, could be very small, therefore. But when it comes to fixed income, it's not as straightforward, simply because when you're talking about bonds, right, they are usually OTC traded. So you're not buying them essentially on the stock exchange.
It's not as liquid.
Yes.
It's privately traded.
Yes,
OTC.
there are not many exchange traded so-called bonds. I mean, we have some, let's say, on the SGX, right? Though some of the retail bonds that are traded on the exchange, but it's a very small quantity of bonds and choices for us. So when you're talking about the wholesale bonds that are OTC traded, then we're talking about, firstly, a huge investment outlay. Usually it takes about $250,000 to buy one bond. So I think for an ETF issuer, then when they look at this universe, then they don't do 100% full replication, because there's a capital issue. There's also, of course, the ability to replicate fully based on the liquidity point that you brought up, and so on. So it could be a partial replication of the index. They just probably want to ensure that it's close enough and good enough for them to be a good proxy for the index. That's usually what happens for bond ETFs. Yeah.
So then what is an okay tracking error then, in this space, based on your broad understanding?
I think the tracking error, usually there would be numbers given by the different ETF issuers, and it varies. I think for some bond universes, especially maybe the US side, like your US treasuries, I think the tracking error could be quite small. But there could be slightly higher tracking errors for certain sectors of bonds. So if I can maybe bring up the example of the Chinese bond market, which has become a little bit more prominent in recent times, because there were two ETFs that were listed on the SGX last year. So these are Chinese onshore bonds. So the tracking error, simply because they don't do a full replication, could be a bit higher. You could be talking about 0.2, 0.25, that kind of tracking error, very broadly speaking. And Is it a good enough replication of, let's say, the index that they're trying to track? I would say yes, it's good enough. I think if we go to one of the two, Chinese onshore bonds that will launch on the SGX, they could be having about 50 to 100 bonds inside the ETF, whereas the index could have about 200 plus. So, it tells you that it's really not a full replication, but it's good enough because it's probably from a goal of achieving that kind of yield, maybe the ETF issuer feel that it's good enough. So I think that is probably a more important point. I brought up those two bond ETFs is because I thought it's a very interesting addition to the kind of bond ETF choices we have. Because traditionally, we always look at bonds from the perspective of US bonds, whether it's investment grade or non-investment grade, and also Asia similarly, and also for emerging markets. But Chinese bonds, especially the Chinese onshore bonds, because of the greater opening of the authorities in terms of having access for foreigners, and the kind of yield they can give, and the kind of volatility, which is actually quite low, surprisingly. So even in market conditions like last year in March or even earlier this year, the Chinese onshore bonds actually were pretty steady and not too volatile. And we're talking about, let's say very broadly, the kind of yield we could be looking at is about 3+%. So that's maybe one novel bond segment that could be interesting, I think, for investors, as opposed to, let's say, the sub 3% that we may be getting from the local Sing dollar investment grade bonds.
So then, if we're exploring the Chinese market, right? Everybody is trying to explore the Chinese market these days. As a retail investor, trying to go into like what you pointed out, like Chinese bonds. What are some factors that we need to know that it's different, right? Because my perspective is they operate on a different political, cultural, financial, social system, right? So then, as someone that is so used to Singapore and like in the US and all that, how do I need to see them differently? What are some core ideas?
Yes. I think it's a good point because it's a new kind of investment universe to many of us, including to myself. So I think one thing to look at is what are the kind of things they invest into. So Chinese onshore bonds, like the two ETFs that are launched on the local stock market, they are essentially investing into Chinese government bonds. And one of the ETFs also does a bit of investments in what they call the Chinese policy banks, which are essentially quasi sovereign entities as well, just for the extra kicker or booster in terms of yield. But I guess the main thing to note is, are these investments for that kind of yield that I'm maybe expected to get, is it worthwhile, for the volatility? That's one factor to look into. Second, it's also the currency point that you brought up, because if you're talking about Chinese onshore bonds, then essentially these are RMB denominated products. So your currency point that you brought up earlier is very valid once again, because if I am a Singapore-based investor, let's say I just want my investments to be secured in terms of Sing dollar. To me, I'm being exposed to certain exposure to the RMB movements versus Sing dollar. And the question is therefore, what's my view on the RMB versus Sing dollar currency movements, especially in the longer term? I would like to assume that if I'm going to have an exposure there, that the RMB, by right, because of greater economic powers and maybe the fact that the onshore Chinese bond market is still under penetrated at this point of time, these are potential long-term factors that may help the Chinese RMB to appreciate in the longer term, and therefore that could be extra kind of investment return, let's say, for investors. Yeah. So I think that is one important point for the currency aspect, especially when you look into the Chinese market. Yeah.
Nice. And when we're investing even in China, the primary idea is always like, let's go with the investment grade stuff. Country sovereign bonds, those are like very high quality, based on the grand universe of the bond world, right?
Yes.
But then, at what scenario should I explore corporate bonds or like high yield bonds or like Zhang bonds? Okay, these three words used very interchangeably,
yes,
right?
that's right.
They kind of mean the same thing.
Yep.
So, under what circumstances, should I explore something like that?
Yeah, I think it's back to the point of what am I trying to achieve for this maybe bucket of my investments, or this bucket of my wealth. I bring the term bucket here to say that for let's say our portfolios or our money or investments, right, we could have different buckets, meaning that they could be serving different objectives. So I alluded to this point earlier on, where I have, let's say, an emergency funds bucket, and that one, in a way, I would like it to be quite safe. So for myself, I tend to look at more of the Singapore dollar money market or short duration bonds in that space, because I'm just trying to get a better return than, let's say, fixed deposit rates and savings rates. But I don't want too much risk, because I may need that money quite urgently at the short notice. But if I'm looking at my other buckets where I have more time, then I think that's where interesting sector like the Asian high yield can come into play, or even Chinese high yield can come into play, because I could be getting the extra kicker in terms of return. I could be looking at 6%, 7% possibly, or higher. Of course, at higher risk as well. So I need time to be on my side in that sense. So I wouldn't really want that kind of maybe investments in my emergency funds bucket. But in my retirement fund bucket, I'll be happy to bring in Asian high yield. I think it's a very interesting space, because I could be looking at let's say an average yield of 6%, and a lot of Asian high yield corporate bonds are actually Chinese bond issuers. So in a typical index that tracks Asian high yields, right, I think slightly over half are actually Chinese corporates. So it's not for everyone, because some investors will be a bit concerned about the corporate governance issues and so on, and it's fair enough. And if you look at Chinese corporate bonds, right, and I'm talking about the junk bonds here, a lot of them are also let's say in the Chinese property space. So again, some of us may feel that comes with a certain amount of risk. Yes, the default rates and so on. So I think we have to weigh that versus the probability of defaults, the default risk. And if we think that it's something that's manageable and attractive because of the yield I'm getting, then it's still a very attractive investment. So actually, for myself, I really like Asian high yield in my more riskier portfolios or buckets, because of that kind of yield that I'm getting. And I like to reinvest that so that I get the power compounding effect as well in the longer term. As opposed to, let's say, your government bonds or your very safe investment grade corporate bonds, which are not going to give you 6%. They're just going to give you, let's say, 2%, 3%, right? So good enough for certain purposes and for certain investors who are very risk averse. But if you are able to take on some risk, Asian high yield with the short duration features inside, that's a pretty attractive, I would say, idea.
Okay. By the way, caveat to you guys, this is not a recommendation. We're here for education purposes only, right? But following that, I want to hear a little bit, because when we talk about like bond funds, right? The beauty of bond funds is there's a collective. You're not buying into anything in particular, So based on a certain idea, you buy a basket of bonds, right? So then the risk of default, then kind of dilutes across all these different bonds. But what is an okay, default rate then, in such a structure of like junk bonds, Chinese junk bonds?
Yeah, I think certain metrics give us an idea of, let's say, what the market expects in terms of default rates. So it could be a few percentage points high, for example. So that's why a diversified bond comes in with the features that I can, minimize the impact of certain defaults in my portfolio. If you're looking at Asian high yield or Chinese high yield bonds, then I think there are certain assumptions in the marketplace on the kind of default risk that we could be expecting. Our team, or I myself, when I look at it, I think that based on the kind of numbers that we're looking at, and also versus the yield that we're expected to get, it's still pretty attractive at this point. But back to your main point, the diversification aspect of a package product, right? Whether it's a bond ETF or bond unit trust, I think for the kind of default risk you would like to see, of course, it should be yes, it should be minimized.
It should be nil.
I want to say nil, but I think from an investment point of view, you can't always guarantee nil or ensure nil. Yes, sense, right? Especially for active fund managers who may be sticking their head out to say that I'm willing to take certain higher risks, even though maybe this bond may carry higher default risk, but I'm willing to take it because I think that I'm well compensated, let's say in the next few months, by the yield that the bond is giving me. And I think that's the kind of thinking that goes through the mind of an active fund manager. Of course, for a bond ETF, then it's more of tracking the index. There isn't so much of maybe that kind of thinking in terms of bond selection. But of course, your bond ETFs issuers also do the task of also rebalancing. So it's not as if like the bond ETF constituents do not change at all. They do change, and they could change because the ETF issuers have a certain rebalancing process in place to ensure that maybe certain bonds come out, maybe because it's approaching maturity periods, or maybe for other reasons they take them out. Or maybe there are new bonds into the market because there are new bond IPOs as well constantly. And then they decide that, okay, I like this new bond in the market because of the yield that I'm getting, the coupon rate that I'm getting. So they add it in. So even for a bond ETF manager, there's that, constant update as well in terms of the composition of the ETF.
And in that sense, right, you rightfully point out the whole thing about like index, like bond funds, they're following an index, they buy, they hold to maturity to the end of the coupon. Right, that's what most bond funds out there they do. But what about the active bond funds, right? Because that is where the sexy stuff happens, right? Where the secondary market trading in the bond space, where actively managed strategies start to come in, and this is a rabbit hole. It gets very complicated for a lot of people that don't understand. So could you just kind of walk us through some of the short-term measures or short-term strategies that some of these bond funds are using? And whenever we see certain keywords, right, what do we need to understand here?
I think for active fund managers who have bond funds under their care, right, they would be looking at, I would say, the index or the benchmark that they set their fund against. Because I think one of the key metrics is to ensure that they can provide outperformances. So I think they would then look at maybe the kind of yields, the credit risk, the default risk of all the different bonds, and whether they should overweight or underweight certain bonds in their portfolio versus their benchmark. Whether they can do that at the sector level, or they could do it also at the country level, and so on. They could also have some aspects of currency management, because maybe they have certain views on currencies, whether certain currencies will appreciate or depreciate, and so on. I think for investors, first thing when we look at bonds is to maybe just go back to the first few things we talked about, which is if you're looking for safer kind of bond segments, then your more Singapore-centric government or investment-grade bonds could be a first foundational kind of step we can take. Don't expect super high sexy returns for obvious reasons, but those are the
Robin, remember,
yes,
right?
the Robin, but Robin will be there to
Robin is always your friend, right?
Yes, will be having your back in terms of ensuring that when times are bad, the portfolio just doesn't go downhill 100%. So I think that's what that is for. And then I think as we then look at, okay, what else can I look into to give me the extra kicker in terms of yields and potentially returns and so on from a total returns perspective, including the price appreciation perhaps. Then I think that's where your high yield bonds come in, and a lot of it could be from Asia, because that's a sector that looks pretty attractive from a valuation perspective. And to just then look at the mandates of the ETFs or the unit trusts. Because I do understand that certain investors also may have their preferences because of, let's say, costs. Then they like, okay, I would rather go for the ETFs because of the lower cost. And I think there are merits in that, especially for very simple bond ETFs. For that kind of, 10, 20 bips a year. I mean, it's really low cost to go and have some exposure into some of these government bonds and so on. But maybe if you're an investor who wants to have a bit more active management because of the potential for higher returns, but also maybe you want some Sing dollar hedge currency classes, then I think that's where the bond unit trust could be a bit more interesting. So very simplistically, I would like to maybe keep it that way in terms of what we should focus on. Because I think your question was about how the fund manager could be looking at how he manages his portfolio. There's a lot of things. Yeah, and there's a lot of risks as well. Yes. I mean, if I can maybe talk about some of the risks, for example. So a lot of fund managers or bond ETF issuers, we'll be talking about, let's say, currency risk, which we talked about quite a bit. We can also be talking about interest rate risk because depending on the kind of interest rate expectations we have and the market has, that also impacts the potential prices of bonds going forward. So I think entering 2021, right, I think one of the key investment themes that popped out was, in a way, because of all these very loose monetary expansionary policies, right? Just print nonstop. So essentially, then what that means is that there were some concerns about, hey, you know what does that mean for inflation? And when there are inflation risks creeping into our mindset, then that's when we would be thinking, oh, the regulators or the central banks would start to want to increase interest rates. So there's been a bit of talk in the markets in the last few weeks on this in the US, and of course a lot of the policies in the US would impact us even in Singapore from monetary policy and interest rate policy. So when that happens, then when there are expectations of interest rates going up, then of course there's that negative relationship between interest rates and bond prices. So that could then impact some of the bonds price movements because of all this speculation on what may be happening. Yeah. So interest rate rates is definitely another key thing that I think fund managers and even as bond investors we should also keep an eye on as well. Yeah.
In that sense, when we go and kind of stew everything down to a bond fund, there are all these different bonds packaged into it, right? And as a retail investor, I could always just pick the best and just pray everything works, right? In essence. But then there are other things like maturity, time, the amount of bonds that come into the fund. How do I evaluate all these things? Do I need to care about maturity length, coupon payments, and the amount of bonds that keep coming in? It's like a deal flow kind of thing, right? Does that matter to me, or how does that work?
I think as investors, especially when we are buying a bond ETF, for example, right, we don't have to be too overly worried about all these different things because I think it's down to, let's say, the investment mandate of that bond ETF we chose. That would give us certain broad picture of what kind of returns and risks I'm looking at. In the interim period while I'm invested in that bond ETF, yes, there will be different considerations. I think I mentioned about the interest rate risk, which is very much linked to the duration, the average duration or weighted duration of the different bonds in the bond ETF. Because when you have a bond ETF with, let's say, an average weighted duration that is quite long in terms of number of years, then I think if there are interest rates concerns about interest rates going up, right, then I think that would have a more negative impact on a bond ETF with a longer duration as opposed to a bond ETF with a shorter duration. So I think those factors...
Can you give some clarity there? Why is it like that?
I mean, duration, very simplistically, if I can explain it, is let's say for a certain amount of increase in interest rates that we expect in the market, let's say we expect for, there's a 1% increase in interest rates, we could expect the bond price to also change about 1% in the opposite direction because of that inverse relationship. So, the bond price could be down 1%. But if the duration is long, we could then expect, let's say the duration of the bond ETF is, let's say, 5 years. So if we expect interest rates to go up, let's say, by 1%, then we could expect the bond prices to decline by, let's say, roughly 5% based on the duration. So that gives us a certain very broad picture idea of what could happen if interest rates move. I'm using the example of interest rates going up because I think that's what markets are worried about at this point. So
and I don't think it can go down anymore.
Yes, that's right. I mean, interest rates have come to that kind of level, that kind of low level. So duration in that sense is an important thing. And I think a lot of your bond ETFs fact sheets do have the information on average weighted duration of all the bonds inside. So that's one important metric that I think you pointed out that is useful for investors to just have a rough idea. Yeah, because when we go for this kind of environment now, where there are certain inflationary risks, and therefore we could expect interest rates to rise at some point. It's a more question of maybe when. Then I think the right thing or strategy to adopt is to go for the shorter duration bonds as opposed to maybe having very long dated or long duration bonds in your portfolio. Yeah.
Nice, cool
Yeah.
stuff. Yeah, I think you share a lot of stuff. But one last question, since we talk about negative interest, how will that affect, our bonds? If let's say we own bonds, and if interest rates continue to stay low, or maybe even, explore the negative territory further, how does that play out? How would that look like?
Yeah, I think if this situation of interest rates of very low to zero interest rates, in fact, in certain markets we're talking about negative real interest rates already. So if this persists, then of course a lot of your safe havens that we were talking about, a lot of your developed markets, government bonds, are not attractive because. I mean, who want to get quasi 0% kind of returns, and maybe even real negative returns when you take into account inflation expectations and inflation rates. So of course, if this kind of low interest rate environment persists even longer, then all the more I think it's more interesting to look at within the bond space, to look at the higher yielding segments and to see whether it's worthwhile taking the extra risk to get that extra returns. Let's say in the high yield space. Yeah.
Okay, cool. I think you've shared a lot of good stuff. Is there any other thing you want to add?
I think for bonds, maybe I should just add that even for myself, I do have some exposure as well to bonds and for my portfolio. And I think in terms of what it can do or how it can benefit me is really in terms of the kind of regular coupons I get. I also like the fact that for the actively managed bond funds I have, I can reinvest the so-called coupons that I get, let's say every quarter or every 6 months, just to enjoy the power of compounding in the longer term. So I think from a portfolio perspective, for many investors out there, if you're looking to build your portfolio, you want to have your exciting growth equities and so on, right? Fair enough, but you also want to consider having a little bit of bonds if you haven't done so, simply because of the kind of protection and less volatility that it brings lah. And also the kind of regular coupons that it gives me as well. I think it's worthwhile considering a portfolio with equities and bonds as a diversification kind of a way of managing the risks that we face in global markets. Yeah. As opposed to having 100% in equities or 100% in tech, I think those are not very advisable for any investor unless that bucket is just like 10% of your overall wealth, and you just want to be more aggressive. Yeah.
And that's a story for another day.
Yes, that will be
Thank
another
you.
story. Yes.
Thank you. Thanks for coming on. Awesome.
Yes, you're welcome. Yep.
Hey, I hope you learned something useful today and truly appreciate that you took time off to better your life with the Financial Coconut. Knowledge is that much more powerful and interesting when shared, debated, and discussed. Join our community Telegram group, follow us on our socials, sign up for our weekly newsletter. Everything is in the description below. And if you love us and want to help us grow, definitely share the podcast with your friends and on your socials. Also, sign up for our members backend for more investment-related content, live discussions, curated content, and most importantly, your commitment to us is a step forward for us to continue creating great content focused on you rather than advertisers. For more information, check out thefinancialcoconut.com. With that, have a great day ahead, stay tuned next week, and always remember, personal finance can be chill, clear, and sustainable for all.
Okay, I have 3 questions that I ask every single guest. Okay,
Yeah.
so first question is, what is a core life principle that you hold closely to?
I think one key principle it's to keep learning. Yeah, I think I've been working for I think coming to close to 2 decades, and I'm just always surprised sometimes in the course of my daily work by the things that I come across that are new to me. It's not just in the investment world. It's also, of course, just the work, working with my colleagues, with my teammates. So I learn from them as well. So I think the concept of just to keep learning it's probably underappreciated, maybe to some extent, or maybe we sometimes take it in a very practical way where we feel like we need to take a course or or take a master's course. But I feel it's just daily
future
things.
like that.
Sorry?
Skills future like that.
I mean, there are good skills future courses for sure.
But yes.
Yeah, but I think it's just to keep learning from everyday things, and I think that keeps me feeling refreshed and also curious in how I approach things. Because in the daily course of my work, there's so many things happening. It keeps us very busy, sometimes quite stressed up and so on. But when I just remind myself of, hey, but I'm here to learn from this. It could be maybe something not very pleasant as well. I think it just opens up my mind to how I can maybe learn from it and share that with, let's say, my colleagues or even my kids. I think that's something that, I really believe in. Yeah.
Nice, cool. Next question. What is the personal finance advice that you feel needs to be further propagated?
I think that, when it comes to investing, we should be thinking of how we can minimize the emotional part of it. So it's very conceptual, but what I'm trying to say is...
Meditate. You say.
Yeah, it's because I think a lot of us, including myself, when I started off investing, right, after school, after uni, then I get very carried away by buying all the exciting stocks, and I think I then lost track of the reasons why I'm here to invest. And I will remember that along the way somehow, but then I may then get distracted again, simply because of markets going down. Then people are worried, and then I may then make a decision to maybe I should also then sell, or there's a fear of missing out. Like in the last few months, I've heard friends basically punting on GameStop. Yeah, so. I mean, nowadays when I hear that, I'm not tempted to join. I don't fear of missing out. But maybe 15 years ago, I would have. And I think my advice, therefore, is to be very focused on what you really want to achieve. And one way to do that, right, to be very robotic and mechanical and in a way boring in your strategy, right, is to have a regular savings plan, something disciplined. And that is the part where, no matter what, that you're just going to be invested. Do your rebalancing once a year just to make sure that your asset allocation is in order. The expensive stuff in the portfolio that has risen up a lot, you trim down a bit, take some profits from there, and allocate some of your profits into other sectors that haven't done as well. So I think that is one strategy that I think for the last few years I've really believe in the merits of, because I can see my portfolio just steadily growing as a result. And if I could have told myself 20 years ago when I started off what I should be doing, then really I would have done the regular savings plan. So I have a few interns in my company, and they're so young, 20, 21. So I always tell them, it's good that you're punting, speculating in a lot of exciting stocks, commodities and whatnot, right? And I say, learn from it, learn from the experience. But start a regular savings plan in something quite boring, like maybe even a bond ETF or an equity fund. And I told them, maybe in 10, 15 years' time, let's catch up and let's just look at how that part of your portfolio has performed. And because I'm quite confident that the boring part would have done quite well. Yeah.
Nice. Thank you. Number 3 is, which part of your life are you giving additional focus on now?
I think in terms of focus, at this point in my life, it's to just be healthier. Yeah. So whether it's from a mental point of view or from a physical point of view, in terms of exercising, hopefully eating better, and so on. And
we're already 1 month away from CNY, right?
Yes. So my New Year resolutions, I think, still kind of on track. I haven't given up on the goal of trying to exercise more frequently. And I think why I've been looking at that more recently is, yes, I've gotten obviously older. I've entered a new phase of my life, hitting 40s and all. But it's just that I think when I'm healthier, it helps me to do a lot of things, I think, better. Whether as an employee in the company, in terms of making perhaps some decisions, or to work with my colleagues and the clients, or even in a very personal way, dealing with the family and my kids, my young kids. So I think, when I see myself as healthier, I can do a better job in all these different functions. I think pandemic as well has helped me to maybe refocus a bit of my priorities and energies into maybe what I should be doing. So it's not just, let's say, always work, but it's just being healthy, and that actually helps me to do maybe more at work, in fact. So a bit of that kind of thinking in the last few months. Yeah.
Nice, good stuff. And I like that you call it functions.
Okay, take care. Thank you.
Yeah.
Love it.
Thank you.